All right, let's talk about one of the most hotly debated tools in a Forex trader's kit, divergence. Is it this secret weapon that can predict the market's next big move? Or is it just a confusing trap waiting to spring? Well, let's find out.
And look, right away, you see the problem. You've got one group of traders calling this thing the holy grail, the absolute best. But then you've got another group saying it's, well, basically useless. You just don't see that kind of split opinion on a trading strategy very often. So that's the big question we're going to tackle in this explainer. Is divergence really a powerful secret weapon, or is it a trading trap just waiting to catch you off guard? The answer, as you're about to see, is kind of somewhere in the middle. Okay, so before we can even begin to answer that, we've got to be on the same page. What exactly is divergence, and why on earth does it get traders so fired up? So in simple terms, divergence is basically a disagreement. It's what happens when the price of an asset is moving one way, but a technical indicator, usually an oscillator that measures momentum, is starting to move the other way. And that little disagreement, that imbalance, hints that a change in direction could be just around the corner. Here's an easy way to picture it. Imagine price and momentum are two partners dancing. When they're perfectly in sync, moving together, the trend is strong. But when the price zigs and the momentum zags, that's divergence. It's a sign that the energy behind the price move might be fading out. And here's how that disagreement actually looks in practice. In the top row, you might see the price plunging to new lows, but the indicator just can't keep up. It fails to make a new low. Or in the second scenario, the price is soaring to new highs, but the indicator is losing steam and won't follow. That conflict is the signal. So what does it look like when this all comes together perfectly? Let's check out the dream scenario. You know, the kind of trade that makes you think this stuff is absolute magic. For this, we're winding the clock all the way back to late 2006. We're looking at a trade between the US dollar and the Japanese yen. And this right here is a picture-perfect textbook case of what we call bullish divergence, a sign the price was about to head up. And here it is, the textbook trade. You can see the price action takes a nosedive, hitting a clear lower low. But, and this is the key part, look at the momentum indicator below, the MACD. It's doing the exact opposite. It's printing a higher low. That's the imbalance we've been talking about. And the result? Bam! The price turned on a dime and shot upwards, making anyone who spotted that signal very happy. But we all know trading is rarely that clean, right? So now let's get real. Let's look at the other side of the coin, the messy, imperfect reality of trading these signals. So just a few months later, on the exact same chart, the very next divergence signal pops up. And this time, well, it was a completely different story. It was anything but perfect. And this is where things get tricky. See, the oscillator below is showing a clear lower high, screaming weakness. But the price itself, it's just a choppy, ugly mess. It didn't make a clean new high. Anyone who tried to bet against this signal probably got whipsawed. That means they were thrown around, stopped out over and over by the jerky price moves. Now, the signal did eventually work out, but man, you needed nerves of steel and a very wide safety net to survive the ride. Okay, so we've seen the dream and we've seen the nightmare. So what's the big takeaway? It's that the signal itself isn't enough. You absolutely need a smart playbook to handle the messy ones. So here are the golden rules. First off, zoom out. Stick to longer-term charts, like the daily chart or higher, because they filter out so much of that random noise. Second, and this is non-negotiable, always use a firm stop loss. It's your safety net. And finally, if the market looks choppy and messy, like in our second example, don't be a hero. It's okay to sit it out, cut your risk, and just wait for a better opportunity. And here's a really smart technique for dealing with all that uncertainty. It's called scaling. Instead of going all in at once, you just dip your toes in. You start with a smaller position. If the trade starts working, moving in your favor, great, you can add a little more. And if you see momentum starting to fade, you start taking profits off the table, piece by piece. It's a great way to protect yourself and manage your risk. Okay, so let's wrap this all up. After looking at both the good and the bad, what are the most important things you need to remember about trading divergence? First, divergence is simply a signal of an imbalance. It's a warning sign, not a guarantee. Second, yes, it can be an incredibly powerful tool for sniffing out major market tops and bottoms. But, and this is a big but, The signals are never perfect. They can and they will mislead you sometimes. Which brings us to the biggest point of all. Having a smart strategy is way more important than finding a so-called perfect signal. And that really leaves us with one final thought to chew on. Maybe the real skill, the true holy grail of trading divergence, isn't just about spotting the setup on a chart. Maybe it's about having the strategy and the patience to manage the signal's inevitable imperfections.